Okay, folks, we're looking at the Euro USD. Okay, and we're going to be looking at an ICT buy signal, or for an example of a ICT short-term buy. And the two primary patterns I trade is a turtle soup or a first return. Is a turtle soup or a first return optimal trade entry into an order block. This trade that we're going to be showing you here is framed on the basis of a turtle soup that was the origination of the move, would cause the market to suggest higher prices. Again, it's being the daily chart. Price moves down and rejects. Okay, we are not in the move yet here unless you're trading a break below this low here for a turtle soup. The optimal trade entry into an order block is going to be seen by taking the down candle and the high. What we do is we take that as our range for institutional support. You see price comes right down into it here, right on this day here. It comes in at February 12th, 2014. Now when price drops down into this price level, we would be hunting buying opportunities once it trades down inside this range. Now the high on that candle comes in at 135.71 and the opening is 135.57. It's a very short range in terms of what we'd expect to hunt an entry in, but we would be looking for the minimum threshold or first level at which we would hunt the long opportunity at 135.71 with the expectation of allowing price to dip down as low as 135.57. Okay, and here we are on the 4-hour chart looking at price action as it dipped into this area right here. Okay, we have it here as well. Okay, and we also have a down candle prior to the move up, which is what we are looking for an optimal entry. And when price drops down into this level here, this is the very moment or very instance you start to take an entry, or you do your long entry. And now the time of day for this particular setup is 12 GMT, which is a classic ICT New York Open setup. When an entry on a long basis is entered, the first thing you're going to look for is where is your risk going to be. Okay, and whenever we're looking at ranges, we have to consider the mean threshold. Now the mean threshold is basically the 50% region. Okay, and I'm not going to show it on there. Whenever we look at ranges, we have to consider the mean threshold. That means the minimum level of which the range is outlined. So in other words, if you have a range of 100 pips, 50 is basically the mean threshold, okay, or halfway point. Generally, we like to see the 50 to 100 pip range to act as support for moves that are dropping down into a bullish order block. And we like to see if, for instance, if the range is 100 pips, again, 100 being the high and 0 being the low end of the range, we would like to see the 0 or minimum threshold up to the 50% or 50 pip range for the optimal level for selling short. And what do I mean by that? Well, if you take this area in here and we say, for instance, this is the total range, okay, and it happens to be 15 pips. 7.5 pips into this range is about the midpoint, and we don't want to see a move dip down below that. Okay, so what that means is if this is what we're looking at, okay, right about there, 7 pips, okay, we want to go at least 10 pips below it. So there's your stop. I'm sorry, there's your stop right there. So this is where your stop loss would be. Now, if you want to be a little bit more conservative and allow more, um, um, I guess, movement, okay, you can go with a 20 pips below the mean threshold, and that would be your stop as well. Okay, and you define your risk based on your equity with these two price points at which your stop would be placed. Okay, so we have two areas at which your stop loss could be used for the long entry. And you want to be using the spread for your purchasing on long entries. You don't have to factor so much on selling short because you're usually selling the ask price on most of your platforms, if not all of them. If, as a matter of fact, the long entry always have to factor in that spread. So if you're looking for an area down here to be a mean threshold, you got to allow a little bit of, um, I guess, human nature to come into your trading a little bit. So that way, if you're looking at this upper level here, 135.71, which again is the high on this candle over here, which is the minimum threshold we would expect to see price to reach down into. You want to take that level and at least add 3 pips to it. Okay, so again, that would be 135.74 would be your entry. Okay, down to your stop here, which would be in this case 26 pips, and down here would be 36 pips. Okay, so if you want to be conservative, your stock could be around 36 pips or 26 pips. Okay, allowing for movement because we're looking at a 4-hour chart. Now, this is for folks that don't want to have to be in front of the charts. They want to be away, being able to have their job, be able to do the things they normally do on a daily basis, and not be so required to be in front of the charts all the time. You could set this trade up pretty much on an autopilot. Buy stop at 135.74 with stop loss at 135.38. There's your risk. Okay, it's defined. Your entry would be taken upon in the form of a limit order. You'd be taking long entry basically on a limit. And where would you be looking to take profits at? Well, the range at which it's dropping down into, short-term trading is highly effective when you use old highs and old lows. And we're going to see that here. Okay, so we have an old high. So we'd be going long in here. So this would be your defined risk. And your expected profit essentially 4 to 1 almost. Okay, so if you take an exit on a limit above this.